The UK financial crisis is getting worse, and the Bank of England is going into panic mode. I'm going to explain this to you and try to go over what the end game might look like in one simple, fast step. Step number one, let's go over the fact that collapse seems inevitable. And if you think that I'm using hyperbole or I'm fear-mongering, I would challenge you to stay to the end of this video, and I can guarantee you'll explain it in the exact same way. But you might explain it with a few more four-letter words. So let's get to the chart and go over what happened with their emergency stimulus package from just a week ago and go over what they just announced. This bombshell announcement from yesterday that they were expanding the QE program and going in and intervening in the infamous repo market. Let's get back to this chart here. It starts on the 12th, goes all the way, and basically this is the date. So it starts September 12th, goes all the way to October 10th, yesterday. On the left, we go from 3.25% up to 4.5. This is the 10-year gilt, their version of a 10-year treasury government bond. So we start off on September 12th, and it's about 2%. Goes up gradually, but starting on the 20th, it goes parabolic within 3-4 days, all the way up to 4.5%. And this is when the pension funds start calling the Bank of England and say, help, bail us out. We're getting margin called. We're going to go bust. So then they come in on the 28th and make this announcement. Remember, they started QT, quantitative tightening, about a week prior. But then they stepped in and said, okay, whoa, time out. We understand the problem here. This is a financial crisis. So we're going to step in and reverse QT and start doing QE. But it's only going to be temporary. Yeah, right. It's like Milton Friedman says, the most permanent thing is a temporary government program. Getting back to the chart here, this actually worked. It calmed the market, and the interest rate on the 10-year gilt went down, meaning the price started to stabilize and go back up. This is basically a bailout of their pension funds. But it's not just the pension funds. See, they were levered up to buy these gilts in the first place, and they were getting margin calls. Well, you have to ask, where's the counterparty? Or who is the counterparty? Is it Credit Suisse? Is it Deutsche Bank? And maybe that's why their credit default swaps have skyrocketed in price, meaning the counterparty risk has also increased exponentially? I don't know. But this only calmed the market until about the beginning of October. And then what you'll see is the interest rates have gone right back up to where they were prior to the Bank of England intervening in the first place. And that's why I've got this kind of Macaulay Culkin Home Alone stick figure, because I can guarantee you when these interest rates are going up, that's exactly what the people at the Bank of England are doing. So like we said earlier, they've gone from intervening in the bond market to now going to even more extreme measures by expanding the intervention and going in to the repo market. To get the details, editor, let's go right to the internet. So this is the press release the Bank of England came out with yesterday, October the 10th. So they start off by mentioning that this is only a quote-unquote temporary program, and it's supposed to end October 14th. And if you're scratching your head right now and saying to yourself, wait a minute, George, isn't that just this Friday? Yes, you would be correct. So 4 or 5 days prior to them saying that they're going to end the program, they're actually expanding the program. So what are the chances that they actually end it on Friday? Probably slim to none, and Slim just got shot. More on that in a moment here. So let's go over their 3-step process to expanding this program. First, the bank will stand ready to increase the size of its daily auctions to ensure there is sufficient capacity for gilt purchases ahead of Friday, 14th October. So let's go over this to make sure we're all on the same page here. They are literally expanding the size of their program 4 to 5 days prior to when they say they're going to end the program. So my question to you would be, if they're going to end the program Friday, would they really need to expand the size of their bond purchases just a few days before? I don't think so. Going to the second step, the bank will launch a temporary, again, I don't know how temporary this program is, especially when you consider the first program of quantitative easing is supposed to be temporary and end this Friday. But they'll launch the temporary expanded collateral repo facility, or TECRF. These central banks love their abbreviations, but this is TECRF, not to be confused with everybody's favorite facility right here at the Federal Reserve in the United States, the Money Market Fund Liquidity Facility, better known as MILF. And I can guarantee you this is definitely my good buddy Robert Kiyosaki's favorite facility, central bank facility of all time. But getting back to the serious business of going over the Bank of England's emergency stimulus plan. So in this TECRF, or temporary expanded collateral repo facility, what they're saying is they're expanding the types of collateral they will allow. And I want you to notice they're including pretty much everything, including corporate bond collateral. So this is a bailout not for just the pension funds, but for pretty much any financial institution that has corporate debt on their balance sheet. It's very similar to what the Fed did during the cerveza sickness. Third, the bank will also stand ready through its regular indexed long-term repo operations each Tuesday to support further easing of liquidity pressures facing LDI funds. And again, if these LDI funds need all of this additional easing of liquidity pressures just 4 days prior to when they're supposed to end, why should we believe this program will end? Why shouldn't we assume, in fact, getting closer to Friday, they'll actually expand it even further? And this is probably my base case. More on that in just a moment. And they go on to add something to their long-term repo operations, that they're doing a short-term repo facility launched just last week, which offers an unlimited quantity. You heard me right. Unlimited quantity of reserves at bank rate, and this is happening each Thursday, just FYI, so you can put it on your calendar. So basically, what the bank is doing, or the Bank of England, is they're just saying, hey, bring any collateral you have. We'll do anything you want. You want a short-term repo? You got it. You want a 6-month repo? Bam, bam, bam. You got that too. You know, it reminds me of a used car dealer. It's like one of those commercials that you see on TV. In fact, the editors found a perfect TV commercial, used car TV commercial nonetheless, that explains, or I think is an example of exactly what the Bank of England is doing right now. Editor, cut to the clip.
Yeah! What's up? I'm Ted the Iceman Jackson down here at Top Gun Motors. We got a maverick of a deal for you. It's going to totally take your breath away. It's going to send you right through the danger zone. Check me. I got a red car. I got black. Red, too. No money down. Keep it rolling. Keep it rolling. Keep it rolling. We got down here maverick motors. We got plenty of deals. We got all kinds of stuff. Oh, come on down. Come see us.
Isn't that exactly what the Bank of England is doing right now? Instead of, I got a red car, I got a black car, I got a red car, and then they just get crushed by, let's say, the marketplace, and they're just laying on their back and saying, but we'll do anything. We'll make any deal. We'll take any collateral. It's just like that guy in the commercial. So this is the position the Bank of England is in right now as we speak. Editor, let's go right back to the whiteboard. So we've gone over what the 10-year gilt market has done in the past month or so, all the way up to yesterday. And I think today it's trading about flat. I want to be very clear. I'm just going over the 10-year gilt market as a proxy, but it doesn't mean that all the other bonds on the whole curve have done the exact same thing. But let's kind of think through about what may happen over the course of this next week, getting closer and closer to this very key date of October 14th, which is when they're supposed to end this program. I think it'll be fascinating to watch this video after the fact so you can look back on what actually happened. But if we're trying to think through how the marketplace will respond to this end date, this deadline, I think you have to put yourself in a position of someone that had a lot of these 10-year bonds on their balance sheet. Remember, the price has an inverse relationship with the yield. So the yield goes up, price goes down, or price goes down, yield goes up. So today is the 11th. So if you had $1 billion of these on your balance sheet and you knew the Bank of England would stop intervening in the market, which one can assume is the only reason the interest rates didn't go parabolic and go even higher to infinity and beyond, which means the price would go plunging down to the same degree. So if you're looking at Friday saying, okay, there's a risk of those interest rates doing the exact same thing when the BOE exits its intervention into the market, why on earth wouldn't you sell going into that date? I think the answer is you would. And if it is true that the Bank of England is only committing to a maximum number of bond purchases per day, which, by the way, they haven't even utilized their full capacity, but they're saying that we're going to buy a maximum of this number of bonds every single day. Why wouldn't you start selling to the Bank of England right now at a higher price if you knew going into next week or after this date, the price would most likely be much, much lower? So I think it'll be fascinating to watch and see what happens, to see if the market sells even more than the Bank of England is willing to purchase, as stated by that press release, and to see what their response will be. If the interest rates really shoot higher like they did here, will they come in before Friday and say, oh, whoa, time out here. Yeah, that end date, we were just joking about that. And that maximum number of bond purchases per day, yeah, you can go ahead and forget about that. Let's just go right back to Top Gun Motors. You got this collateral, you got that collateral. We'll take anything. You want to do a repo, a 6-month repo, a 3-month repo. Yes, anything you want to do, you got it. So my base case, and remember, there are no certainties, only probabilities, is this quote-unquote temporary program will become permanent, just like Milton Friedman warned us about. And the Bank of England will become pretty much the entire market, at least for the long end of the yield curve. So the 10-year and the 30-year bonds. And maybe they'll even become the most significant counterparty in the repo market if they're not already there. But I think that what this does is make the short end of the curve, or at least their rhetoric and what they have to do at the short end, even more hawkish. Meaning, as they're doing more and more quantitative easing, and as it becomes more and more permanent at the long end, the market realizes this. This could increase inflationary pressures there that are already sky high. So this forces the Bank of England to raise rates even more at the front end to try to combat the consumer price inflation so the politicians can get reelected. And this puts downward pressure on the economy and the stock market. And I'm not the only one with these types of concerns. Editor, let's cut to the internet and see what the professionals are saying. Antoine Beauvais, senior rate strategist at ING Group, said the BOE is clearly playing gilt sell-off whack-a-mole. I think that's a great way to look at it. And Richard Maguire, head of rates strategy at Rabobank, said the Bank of England is attempting to mask the symptoms, but it can do nothing to address the cause. So I think the main takeaway is the end game here is this crisis, this financial crisis in the UK will most likely get much worse. And we could even see a financial collapse. Will it be a deflationary collapse or maybe an inflationary crisis like we saw in the 1970s? I think it all depends on the fiscal side of the equation. We're talking about monetary policy, but will the government come in and stimulate like we're seeing in France right now? They've got an inflation problem, but in order to fight this inflation problem, they're not raising rates, they're just giving people more money to the tune of $100 billion just so they can afford the higher prices. You guys know this will obviously make the matters much worse. Or will these higher interest rates at the front end of the curve cause a deflationary asset bust, which will bring down the prices in the real economy, creating disinflation to alleviate some of the pressures on the Bank of England? But regardless of whether this plays out in an inflationary, disinflationary, or deflationary way, they've got some rough road ahead of them across the pond. And then the big question becomes, what are the systemic risks? Is there contagion with entities, the banking system, across Europe and in the United States? For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.